Hello and welcome to our revision course looking at the Statement of Financial Position. Now this is a group statement of financial position for question 1s on the paper. So question 1 will be a group's question. It will either be a statement of financial position, an income statement, or both together. And we're going to look at December 2011 question 1 to try to see how to attack these statements of financial position. And the good thing about them is that they're pretty much always the same. So we can get a set way to do them. We can do that set way each and every time we undertake this type of question. So how do we approach this question? Well, it's always using the same 5 workings. So the first working that you need to do is to set out the group structure. So how do we do that? Well, what we do is we read through the notes that we're given for the question. So we read through the question probably during the reading time that we have available for this paper. As we do that, we can identify who is the parent, who is a potential subsidiary, who is a potential associate, and what that group structure is. So identify the parent's percentage, the dates that things have happened, the consideration that's been paid, and think about any perps that may have occurred, because those we can deal with at any time, but we might want to deal with them at the start, get them done and dusted and out of the way. So let's see how to do this. Let's do it for December 11 question 1. So pause the video now, have a look at this question. You should have printed it out and you should have it in front of you. Read through it and see if you can set out the group structure. So who the parent is, who the subsidiary is, are there any others within the group, how that group is structured, and what dates everything has happened. So identify all of the important dates that there are with reference to that question. So remember, the question that we're looking at here is December 2011 question 1, and we're looking at the international paper. Remember that the UK paper and the international paper are pretty much the same paper now. But if you were looking at the UK paper, there are very slight differences in the question. Not that the treatment will be any different, just a very slight difference. So make sure it's the international question that you're looking at. So it's Paladin, Saracen, and Augusta. And first thing we need to do is to set out our group structure. So be very careful with the dates here. So we have Paladin, and set out the date that we're preparing our statement of financial position up to. So we're preparing our statements for the 30th of the 9th, 2011. So that's the date that we're preparing our statement of financial position on. And if we read through the information we're given, we can see that we bought 8,000 of the 10,000 shares in Saracen. We did that on the 1st of the 10th, 2010. So that means we bought 80% of it, and it was 1 year ago. We can also see that we purchased 25% of Augusta, and that was 8 months ago on the 1st of the 2nd, 2011. It's very important that you note the dates. First of all, the statement of financial position date. Secondly, the dates on which you gained control or you bought the interest in the various entities, because that will determine how much of the profit you need to bring in. So for example, we can see that Augusta is going to be an associate because we bought 25%, but we've only had it for 8 months. So we'll need to get the parent's share of the associate profit, but only 8 months worth of that profit. And that's where you could make a mistake if you didn't note this all down in the group structure. We can also see up at the top that there's been consideration paid of an immediate $4 per share for Saracen, and a further amount deferred until the 1st of October 2011. And we can identify from note 3 in our question that there is going to be a perp. So we said in working 1, we'd look at consideration, we'd look at perps, and we'd set out the interest that we have in each entity. Now that we have identified the group structure, this is the time that we can deal with any different type of consideration that we might have and any perps. So what I want you to do in your working ones is to deal with the amount that has been paid for the subsidiary. Usually in this paper that will contain some cash, maybe some share exchanges, or indeed some bonds that will be exchanged for the subsidiary. So deal with the consideration at that time, so that's the amount that has been paid by the parent for the subsidiary. Then also deal with any provisions for unrealised profit. That's what a perp is. So provisions for unrealised profit. We should be able to deal with consideration at this stage. Remember, it might be deferred consideration, contingent consideration, cash, exchange of bonds. Any of those we need to be able to deal with. And for perps, we need to get the unsold inventory amount multiplied by the margin or the markup on that inventory, and that will give us the perp. And we need to then decide whether it was a sale from the parent to the subsidiary or the subsidiary to the parent to decide how to deal with it. So see if you can now deal with the consideration. So first of all, see if you can decide what consideration there has been and how to deal with it. And then any perps that there are within this question. And I'll give you a clue. There's some perps and they're in note 3. So have a go at that, pause the video and then work through those two items with me. Looking first of all then at the consideration for Saracen. So the examiner comes up with lots of different ways to give you this consideration on the exam paper, and you need to be able to deal with all of those different ways. In this one, we've got an immediate payment of $4 per share, and then a further amount deferred until the 1st of October 2011. So let's write down first of all how much we paid. So first of all, we had the cash payment. We bought 8,000 shares and we paid $4 per share. So that's 32,000. Then we need to deal with the deferred amount, and it has been deferred for 1 year. So we need to discount that to bring it in to our consideration working. So the deferred amount is 5.4 million. The appropriate discount rate we're given is the cost of capital, which is 8%. So 5.4 million times 1 over 1.08, which is how we discount at 8%. So 1 over 1 plus the discount rate as a decimal. And that gives us 5 million. So 32 plus 5 means that the total consideration paid for Saracen was 37,000. So that's the amount we'll bring into our Goodwill Working when we get that far. But don't forget also that there'll be a treatment during the year for that deferred amount, because we'll need to unwind that discounting that we have on it. So the treatment for the deferred consideration, we'll have to debit goodwill, credit a liability with the 5 million initially. So that's how we get the consideration in the first place. But as we can see, it's not 5 million that we'll pay in 1 year's time. It's 5.4 million. So our liability doesn't match the amount we'll actually pay. We need to get the 5 million up from 5 million to 5.4 million by the end of the year. So in the current year, we'll debit the income statement to unwind the discount with the 5 million balance on the liability times the discount rate of 8%. And that's 400. So that will be a finance cost to the income statement. The credit then is to the liability, and that will increase the liability from 5 million to 5.4 million. So that's how we deal with deferred consideration. We discount it and bring the discounted amount into our consideration. That will go to our working 3 for goodwill. Then that liability that we carry, we need to unwind over the number of years until we actually have to pay it. Now we pay it in 1 year's time, which is the day after our statement of financial position date. So we'll debit the income statement, credit a liability with the amount of the liability times the discount rate. So that's the treatment for the deferred consideration. We'll need to remember to do that both in our statement of financial position and in our working 5. So we'll have the finance charge of 400 to our working 5, and we'll have our liability in total on our statement of financial position, the 5.4 million that we're due to pay on the 1st of October 2011, the day after our statement of financial position date. So that's how we deal with the deferred consideration. We also said we'll deal with any provisions for unrealised profit. And we're told that during the year, Saracen had goods bought from Paladin. So remember, that will be from the parent to the subsidiary. They were in inventory at 2.6 million with a markup of 30% on cost. They agreed the current account balance of 1.3 million. We'll deal with the current account balance when we look at the statement of financial position, but the 2.6 million will be the unsold goods. So remember, the PERP is the unrealised profit on any goods that we have in inventory that have been sold between the parent and the subsidiary, or the subsidiary and the parent. In this case, the sales were from P to S, so from the parent to the subsidiary. The total of unsold goods in inventory is 2.6 million. The profit was a markup, and remember, our markup is dealt with as the markup percentage over the markup percentage plus 100. So that's 30 over 130. And that gives us a provision for unrealised profit of 600. What do we do with that? Well, because it's the parent selling to the subsidiary, the NCI won't be affected. So we'll debit retained earnings in our working 5 with 600, the full amount of the PERP, and credit inventory. Because remember, that inventory is overvalued. It includes profit that was made between the parent and the subsidiary. We can't recognise any profit on intercompany sales that remain in inventory. So we need to reduce it. So we remove the profit, we credit inventory to reduce their value back to the cost. And that's the cost that they were to the group. So that's how we deal with both the group structure, the consideration, and the provision for unrealised profit. We now know how to deal with working 1. We identify the parent's percentage. We identify the key dates on which things have occurred. We also deal with the consideration that has been paid, and we deal with any PERPs. That means that by the end of working 1, we know what the group structure is, but we've already gained some marks by dealing with that consideration and the PERPs. So we've already got some marks and we're ready to move on. The next step is to do working 2, and working 2 is our equity table. So the equity table shows the share capital and reserves at the acquisition date and at the year end. So we'll need the share capital and reserves at the acquisition date to determine what the goodwill is. We'll need the reserves and share capital at the reporting date, both to determine what our post-acquisition profit is and potentially to determine our non-controlling interest. In addition to the share capital and reserves at acquisition and at the reporting date, we need to look for any fair value adjustments. On those fair value adjustments, we may also have extra depreciation. So remember, fair value adjustments are where we have items in the subsidiary's financial statements that aren't at fair value. IFRS 3 says what we have to bring in all of the assets and liabilities of the subsidiary at fair value. So if they're not at fair value, we need to adjust them. The adjustment goes into this equity table. So say, for example, the subsidiary has some property, plant and equipment that's at historical cost. Well, we need to value it at fair value for the group accounts. So we'll adjust the value. We'll do it in our working 2, and we may also have extra depreciation on that fair value adjustment. In addition, the subsidiary may also have intangible assets that it can't capitalise in its own accounts. Well, because we bought the subsidiary, we will be able to capitalise it within our accounts for the group. So that also would be a fair value adjustment. And we may also need amortization on that intangible asset. So let's have a look at this for our question. Look through the information you're given. This will usually be in notes 1 and 2 for our fair value adjustments. Determine what the share capital and reserves were at acquisition and at the year end, and see if you can deal with those fair value adjustments that you're given in this question. So pause the video now, do that, and then work through working 2 with me. So we're now looking at our working 2. That is the net assets in the subsidiary, and this is an equity table. So we need to look at notes 1 and 2 to determine this, and we also need to set out both the net assets of the subsidiary at acquisition and at the year end. Remember, the share capital plus the reserves equal the net assets in the subsidiary. So we have the share capital in the subsidiary, which is Saracen, and it is 10,000. So we have 10,000. Those are equity shares of $1 each, both at acquisition and at the year end. We can look at the statement of financial position in the question, and we can see that the retained earnings as at the year end were 12,000 plus 6,000, so that's 18. And at the start of the year then, they were 12. So the accumulated profits at acquisition 1 year ago when we purchased Saracen were 12. We earned 6 in the year, so that at the year end we had 18. Now we're also told that at the date of acquisition, the property, plant and equipment fair values were equal to the carrying amount except a piece of plant. It had a fair value of 4 million above its carrying amount. And at that date, it also had a remaining life of 4 years. So what we're going to have to do is bring in a fair value adjustment to increase the value of that plant by 4 million. And then we're going to have to depreciate it. The extra depreciation we'll need to deal with. So first of all, the fair value is going to have to go up by 4 million. The additional depreciation required, therefore, will be the increase in the fair value divided by the useful economic life. So it was 4,000 divided by 4 years of a useful economic life. So that's 1 year's depreciation that will be applied at the year end. So remember, time needs to pass for depreciation. So it doesn't happen at acquisition, just at the year end. And do look out for other questions that have more than 1 year since we acquired the subsidiary. This we only have 1 year, so we only need 1 year depreciation. However, if it had been more than that, we would need more than 1 year's depreciation. So the other thing we're told is that at the date of acquisition, Paladin valued Saracen's customer relationships as a customer-based intangible asset, and that's at a fair value of 3 million. They haven't accounted for it, but we will have to in the group accounts. Intangible assets, even if they're not recognised in the subsidiary, we will recognise in the group. So the intangible asset comes in as a fair value adjustment. We're also told that these lists last on average for 6 years. So we will amortise it over its useful economic life of 6 years. Again, it's 1 year since the acquisition, so the amortisation will be the 3,000 value divided by the 6-year useful economic life. So that's 500 of amortisation to apply. So that means that we have at acquisition 29,000 of net to assets, and by the year end 33,500. We can also at this stage calculate that the post-acquisition profit will be the difference between the two. So we've made 4,500 of post-acquisition profit in the subsidiary, and we can then take the parent's share of that to our working 5 when we do it. So that's our working 2 with the net assets of the subsidiary. Do look out for fair value adjustments, intangible assets, and don't forget additional depreciation or amortization if you have them. So now that we've dealt with our equity table, we know what the share capital and reserves at acquisition and at the reporting date are, and we've dealt with any fair value adjustments. The next step is to do working 3, and working 3 is our Goodwill Working. So this will be the standard working that you will have learnt either through the full course that you've done with me or through your revision that you've done with another tuition provider. So the Goodwill Working is that standard working. Also at this time, check for any impairment and share that impairment out between our NCI and retained earnings. So let's do that for our question that we have here. Top tip is that we don't have an impairment in this one. So you'll be able to do your Goodwill Working as you would normally do. So have a go, pause the video now, and then work through the answer with me. The next working that we have is our working for Goodwill. So I want to show you 2 ways to do this Goodwill Working. Both are exactly the same in terms of the answer that they give you, but they're structured in a slightly different way. So if you did the full course with Mapit Accountancy, you will have seen this way to calculate your goodwill. We would take the cost of investment, which we got in working 1 as 37,000. That's the consideration we paid for Sanford. We would subtract out the parent's percentage of the net assets at acquisition. So that's from column 1, in our working 2. So 29,000 is the net assets at acquisition times 80%, which is the amount that we purchased as the parent. So that would give us goodwill attributable to the parent of 13,800. We then bring in the fair value of the NCI at acquisition. Now remember that this is often given to you in the question. If it's not, you simply need to multiply the number of shares that the NCI had at acquisition by the share price in the subsidiary at that date. So at the acquisition date, there were 10,000 shares. The NCI owned 20% of them. So that will be 2,000 shares multiplied by the share price of $3.50. And we're given that $3.50 in note 1. So we're told the share price of Saracen was appropriate at $3.50. So that's the fair value of the NCI at acquisition, less the NCI's percentage of the net assets at acquisition. So that's the bit of the 29,000 we haven't used. We've used 80% of it, the other 20% of it related to the NCI. So that gives us goodwill attributable to the NCI of 1,200. Adding the goodwill attributable to the parent and the NCI together gives us the gross goodwill on acquisition. Now this is the working that we used in our full course lectures, and the reason that we did that was because if we're asked for full goodwill or gross goodwill, or the value of the NCI is based on the fair value of the NCI at acquisition, any of those terms mean that we'll need to do all of that working. We'll need to get goodwill attributable to the parent, goodwill attributable to the NCI, giving us the gross or full goodwill. Now that's fine, we can use that working or the other one that I'm going to show you to get gross goodwill. However, if you are required to calculate proportionate goodwill, which we may well be required to calculate, because you can, as an entity, choose whichever way you want to value goodwill. So the examiner may well ask you to calculate proportionate goodwill. And that would mean that we only go down as far in this working as the goodwill attributable to the parent of 13,800. We wouldn't have any goodwill attributed to the NCI if we were calculating proportionate goodwill or partial goodwill. Now that means that if we do this next working, so the following working, and this will give us the same answer as we got in our first working, but we wouldn't be able to get our proportionate goodwill using the second working. I'll show you it now. So the second working is to, first of all, again, start with the cost of the parent's investment, then add on the fair value of the NCI at acquisition. Then that would give us the total value of the business. We would subtract out all of the net assets at acquisition of 29,000, and that would give us the same answer for goodwill, 15,000. Now that would seem like an easier way to do it, and I think it is. However, if you were asked for proportionate goodwill, you cannot get it using that working. The way to calculate your proportionate goodwill is to use the first three lines of our top working, the cost of investment less the parent's percentage of net assets, to give the goodwill. So that's why you need to know both. Now, if you just know the first one, you'll get away and be able to do almost every question. If you know the second one, well, if the answer asks for proportionate goodwill, you won't be able to do it. So do be aware that there are two methods to calculate goodwill. They're both really very similar because if you look at it, both add in the cost of investment, both add in the fair value of the NCI, except at different places, and both subtract out all of the net assets, except in the first working we separate them out. We separate into 80% for the parent and subtract those out, then 20% for the NCI and subtract those out. So both do exactly the same thing to get your 15,000, they just do it in slightly different way. If I was doing this exam, I would know both of these methods, so that I could deal with either of them if they were required. Particularly, you need to know how to calculate your gross goodwill, which would be the 15,000, but also do be aware that if you're asked for proportionate goodwill, you may only have to go as far as the 13,800. So we've introduced both ways to calculate our goodwill there. Each way will give us exactly the same answer, but do be aware of each of those methods. Now that we've dealt with our goodwill, we can move on to our non-controlling interest, our NCI. Now the NCI is the share of the net assets at the year end that the parent doesn't own. And there are two ways to work it out depending on how you calculated your goodwill. So we looked at both ways to calculate goodwill. Let's now look at both ways to calculate your NCI. You have a go using the standard working that you've learnt up to this date and see if you can calculate the NCI before working through it with me. Looking now then at our working 4 for our NCI, well, this will depend on the way that you calculated your gross goodwill in working 3. If you calculated it using the first working that we had, which was separating out your goodwill between the parent and the subsidiary, well then you can calculate your NCI as follows. The NCI's percentage of the net assets at year end, so that's working 2, column 2, times 20%. So 33,500 from working 2, net assets at the year end, multiplied by 20%. So that's 6,700. We then add in the goodwill attributable to the NCI that we worked out in working 3. So it was 1,200. So that was in our first working that we did for goodwill. Adding those both together, we get 7,900. Now, if we did our second working for goodwill, then the way to value the NCI, because in our second working for goodwill, we didn't calculate any goodwill attributable to the NCI, so we can't use that. So what we would need to do is take the fair value of the NCI at acquisition of 7,000, plus the NCI's percentage of the subsidiary's post-acquisition profit. So that comes from working 2. Remember, we worked out that the post-acquisition profit for the subsidiary was 4,500 in working 2, and we multiplied that by 20%. So 4,500 by 20% will give us 900. If we add those together, we get the same value as we did in our first working, 7,900. So those are two alternative ways, depending on how you calculated your goodwill, to calculate the non-controlling interest. Both give exactly the same answer, because really both of them include exactly the same figures. The net assets at the year end for the NCI, the 33,000 times 20%, well, that includes the post-acquisition profit. The goodwill attributable to the NCI then we add on. Looking at the second working, the fair value of the NCI at acquisition, well, that includes the net assets at acquisition plus the goodwill attributable to the NCI. They're both within that 7,000. We just haven't included the subsidiary's post-acquisition profit, so that's why we add on the NCI share of that. So they're both two ways of doing exactly the same thing, but do be aware of both methods, because depending on the information that you're given, you may have to use one or the other. We're now nearly there, so what we need to finish this off is a working 5. And working 5 is our reserves or retained earnings. So we always bring in the parent's reserves from the question. So we look at the statement of financial position given to us in the question, and we bring in the retained earnings of the parent at the start. We then bring in the post-acquisition share of the subsidiary's profit. So the profit will have made by the subsidiary from the date that we acquired them. We'll need to get the parent's percentage of that profit and bring that into our group reserves or our group retained earnings. So start with the parent's retained earnings, then add in the post-acquisition share of the subsidiary's retained earnings. Also, we'll need to look for any other adjustments. So other adjustments will go in here. So before we close off our working 5, we'll look for any other areas we'd need to deal with. For example, if there was an associate. If there's an associate, we'll need a working to work out what our group share of the associate profit would be, for example. That will then come into working 5 also. So this is where we catch all of the rest of the information that we haven't dealt with yet in the question. So have a look through this. See if you can do your working 5. See if there's any other adjustments such as an associate that you will need to calculate the post-acquisition profit on, and then bring it into your working 5. So pause the video now, try that, and then work through the answer with me. So for our working 5, we're looking at group accumulated profit. So what we have to do here is start with the parent's accumulated profit. So we can take that from the question. The retained earnings last year 25,700, then during the year 9,200. So that gives us 34,900. We then also have to bring in the parent's percentage of the subsidiary's post-acquisition profit. So the parent's percentage is 80%, and the subsidiary's post-acquisition profit from working 2 was 4,500. So that gives us 3,600 for the total. Now what we need to do is go through and see if there are any adjustments that we require, both from the calculations we've already done and from the notes in the question. So looking through, the only other thing we need to deal with in the question is the associate. So let's deal with the associate first of all, and then bring in everything else that we require from the question into the accumulated profit. We saw from our working 1 that we had an associate in which we bought 25%. So we'll need to bring in both the profit from that associate into our working 5. So we'll need the parent's share of the profit for the year, but we'll also need to bring in the value of the associate onto our statement of financial position. So remember, the value of the associate will be the amount paid plus all post-acquisition profit since we bought it. And the amount for the year will be the amount of profit in that year that the parent has associated to it. We also need to look for any impairments that there's been, and we'll deal with those both on the statement of financial position value for the associate and then in our working 5 for retained earnings. So see if you can look through the information, particularly looking at note 4 and looking at the information at the top of the question, and get the amount for the statement of financial position and the profit for the year from the associate. So pause the video now and see if you can do the working for the associate before working through it with me. So what we'll do here is we'll bring in the statement of financial position value for the associate. Within that then we'll be able to get the amount that we need to take to working 5 for our retained earnings. So first of all, the investment in the associate was 10,000. So remember, the amount on the statement of financial position for an associate is the investment in the associate plus any share of post-acquisition profit less any impairment in the associate. The post-acquisition profit, well, we've had the associate for 8 months. We've owned 25% of it. In those 12 months of the year, they made 1,200. So we can see in the question, statement of financial position for Augusta, that for the year ended 31st of September 2011, they made profit of 1,200. We need 8 months of that, so 1,200 times 8 over 12, and the parent is only due 25% of that. So 1,200 times 8 over 12 times 25% gives us 200. So that will increase the value of the associate on our statement of financial position, but will also go to our retained earnings in our working 5. So that's the figure that we were looking for retained earnings here, 200. We also need to look to note 4 in the question, because in note 4 we're told that the investment in Augusta was impaired by 2.5 million. So that investment that we made has been impaired by 2.5 million. So we need to deal with that there. And that will also go to working 5. So the amount for the associate on our statement of financial position will be 7,700 or 7.7 million. And we'll also need to bring in both the post-acquisition profits of 200 for the associate in our working 5 and the impairment of 2,500. So now we've done everything that we need to for our working 5, we can finish it off. So go through all the rest of the workings and see all of the things we have to bring into working 5, as well as these 2 items for the associate, and see if you can finish off that working. So this is how far we'd got in our group accumulated profit. We now know the profit from the associate and the impairment that's related to the associate. We also need to go through our other workings and see, is there anything else to come into this working? And the first thing we see is the deferred consideration discount unwinding. We did that in working 1. So that was 400. Remember, it was debited to our profit and loss, or debited to reserves, and credited to the liability. We also then have the share of associate profit of 200, and we have the impairment on the associate of 2,500 that we just dealt with. We lastly then have a perp. We did that in working 1 and it was 600. So we bring that perp in here. Remember, debit retained earnings, credit inventory on the statement of financial position. Adding that all together then, we get 35,200 for our group accumulated profit. Now we've done all of the workings required for our statement of financial position, what we need to do is bring it all together into the actual statement of financial position. So we will add across the assets and liabilities for the parent and any subsidiaries, and we'll use the parent's share capital only. We'll also need to remember to bring in any fair value adjustments, for example, on our non-current assets or intangible assets, and also that we've already done our reserves and our NCI in our workings, so we'll need to bring those figures into our statement of financial position. So see if you can do that, remembering all of the adjustments that we've made, and see if you can get your statement of financial position to balance. So pause the video now and try, and then work through the answer with me. Now that we've done all of our workings, we can pull together our group statement of financial position. So we'll start at the top here with our goodwill. That always comes from working 3 and was 15,000. We also then have property, plant and equipment, so we add together the parent and the subsidiary, plus we had 4,000 of a fair value adjustment and 1,000 of depreciation that reduces that fair value adjustment. So adding those across, we get 74,000. Intangible assets were 7,500 for the parent, plus the 3,000 fair value adjustment, less the amortisation of 500. The associate investment we worked out in working 6 was 7,700, and that gives us inventory then also of 11,200 plus 8,400. Don't forget that we also need to subtract out the perp on inventory. We debited it to working 5 and the credit goes to inventory here to reduce it. So that's 19,000 in total for inventory. Receivables, we have 7,400 for the parent, 5,300 for Saracen, and there was an intercompany balance of 1,300 or 1.3 million, which we were given in note 3. So we need to subtract out any intercompany balances. They'll need to come out of receivables and of course payables when we get there. The bank was 3,400 for P. So adding those together, we get 140,500 for our assets. Moving on to the share capital, well, we use the parent only for our share capital. So that's equity shares of 50,000. Retained earnings comes from working 5, which we got 35,200. Our non-controlling interest comes from working 4, which was 7,900. And we had deferred tax just added across 15 and 8 to give us 23,000. Deferred consideration we got from working 1. Remember, we need to bring in a liability, which was 5 million initially, plus the 400 or the 0.4 million, gives us 5.4 million. The bank is the overdraft for Saracen, which was 2,500. And we have payables added across, less the intercompany that we just mentioned of 1,300 or 1.3 million. Once we add that all up, we can see that the statement of financial position balances at 140,500. So that is how we go about preparing a statement of financial position. Once you've used this technique to do several questions, it's very, very easy to do. You just need to do it quickly and be robotic in doing your 5 workings, looking for any other adjustments, then closing it all off and preparing a statement of financial position. If you do it quickly and you do it diligently, you should get almost maximum marks for this should it come up. However, if you haven't practiced enough, if you're not sure of the workings or you're not sure what to do with several items, this can really damage your chances of passing because you won't get it finished and you won't get the correct answer. So have a go at it, have a go at as many questions as you can, perhaps redo the one that we've just done. And then we're going to go on to look at another statement of financial position, which you can attempt in full first of all, and then work through the answer with me to see how well you did.